Welcome to Looking at the Markets. I have some charts that I want to show you. And right now, as you can see in this first chart, the stock market is over into extreme greed now. And that's when I usually don't like to buy a lot of mega cap stocks. And as you may be aware, the stock market is being led by a small handful of technology stocks. Alphabet, Microsoft, that kind of thing. Nvidia, of course. The stocks that everybody is just buying hand over fist. And that doesn't mean they can't go higher. I mean, just like the needle on this chart here can move somewhat higher. But I like to buy low and sell higher. I'm not into usually buying at a very high price, hoping that I can squeeze a little bit more out of it. Meanwhile, there's a big air pocket below. Okay, and there are exceptions. I mean, it's okay to be a momentum trader if that's your thing. And there may be times when I buy at a higher price if it's justified. But usually I'm buying on fear or extreme fear because then there's a lot of room to the upside. And the downside, well, I mean, it's limited to zero as far as stocks go, at least. If you buy a stock, it can only go down so much. There's a floor. So this is not a great situation for the S&P 500, the Dow Jones, and especially the NASDAQ as I see it. Small caps seem to have more upside potential in my opinion, but it depends on the small cap. It depends on the particular company because small cap companies have certain risks that you want to be aware of at all times, but they could also have more upside if you pick the right ones. And the VIX, the volatility index, that is quite low. And what does low mean nowadays? Well, there was a time back in 2017, 2018 when 8 or 9 was low. But now 13, 14, 15, that kind of thing is low for the VIX because last year it was in the 20s for quite a while. So again, I'm not usually buying a lot of things during times of extreme greed. And when the VIX is low, that means there's complacency. That means people are not alert to the dangers of stocks going down. They're not even thinking about that. They're just buying that handful of tech stocks, Meta Platforms, Alphabet, Microsoft. You get the idea. And they're not aware, or they don't care, that there's not a lot of participation, not a lot of breadth to the stock market rally that's been going on. And we're not coming into a great seasonal time if you own a lot of mega cap stocks. This is from Bank of America Global Research. Seasonal patterns in implied volatility suggest a VIX floor could be near, as the low point of the calendar year is typically July. And so as we get into July, oftentimes, seasonally, we see that the VIX could bottom out in July, according to seasonal patterns. And, of course, these things don't always follow the seasonal patterns, but it's just something to think about. And, I mean, it's kind of happening that way. It's playing out so far with the VIX getting really low as we head into July. So this is from Koyfin Charts on Twitter. I encourage you to check out, anytime I have somebody, I feature somebody on Twitter, I encourage you to check them out, but make your own decisions, do your own due diligence. It's your money, so you're responsible for it ultimately. But this is a chart that I thought was interesting. First quarter U.S. GDP has been revised higher to 2%. You may have heard about that, largely thanks to exports and consumer spending. Notice it's not about producing a lot. Even though it's gross domestic product, it's supposed to be about what we're producing as workers and as businesses, but a lot of this has to do with spending. Maintaining pressure on the Federal Reserve to consider further tightening of monetary policy. Don't be surprised if we get a couple more rate hikes. The Federal Reserve, Jerome Powell, warned about the possibility of consecutive back-to-back interest rate hikes before the year's over. And we know that the stock market doesn't like that, wouldn't like that. And so here you go. GDP for first quarter revised higher, quite a bit higher actually, than originally estimated. Goes to show that estimates are not always so reliable. So this is from Harold Malmgren on Twitter. By saying a significant possibility that there will be a downturn, Jerome Powell, the Fed chair, is signaling he's not afraid of a downturn, according to Harold Malmgren, implying a downturn would not necessarily call for a pivot. And this is his opinion. My gut tells me he really wants a serious recession and major negative correction for equities or stocks. It's possible. Quote from Pythias on Twitter, quote, "There's a significant possibility there will be a downturn," Powell said. "It's going to take some time. Inflation has proven to be more persistent than we expected and not less." And Powell says more restriction is coming, including possibility of hikes at consecutive meetings, 2 in a row, possibly. Now, just because he says something doesn't mean it comes true, necessarily. It could come true. But I'm not going to count on that happening. But it certainly could. Don't be surprised if it does. He is warning you now. So this is Jerome Blokland on Twitter. If markets are right about the Federal Reserve target rate this time, though they have been wrong on most occasions, then monetary policy will remain restrictive above the neutral rate or R-star for a very long time, and all of this without a recession. Magic, right? And so this is the expected path, and doesn't always happen as expected. But if things go as expected, then interest rates will not be going down soon. They'll be going up into the end of the year. And they'll be quite high. And then they'll finally start to come down gradually, but not really low or low-ish until looks like 2025. And even then, they're not super low. Even this rate over here is not low like it was 5 years ago, that kind of thing. So it's still going to be relatively high compared to the past decade, how it's been. The markets have become accustomed, spoiled by low interest rates, and now they have to deal with high interest rates. So I don't imagine that the stock market will like that too much if it actually happens. Then you've got deeply inverted yield curves. You might be aware of that by now. So this is from Game of Trades on Twitter. I want to give them a shout out. U.S. 10-year to Fed funds rate chart here, most inverted since the 1980s. And so when it gets inverted, bad things can happen, right? We can see the Great Recession, the financial crisis here, and then early 2000s. We all know what happened then with the bursting of the dot-com bubble, that kind of thing. The early 1990s recession, I remember that one. Early 1980s recession. So, there's no guarantee here. And of course, the 2020 recession, we all know what happened then. So is this time different? I don't know. I mean, trends get broken, rules get broken, it happens, but it's not a great sign. I know this is kind of blurry, this chart, but bankruptcy filings moving up in recent weeks. So these are weekly bankruptcy filings with a moving average there, a couple of moving averages, and just up, up, up. And we saw this in 2008, 2009. We all know what happened then. And then in 2020, we know what happened then. So here we are, a lot of bankruptcies going on. Are these small businesses? I mean, some people say small businesses are the lifeblood or the backbone of the economy. It's not just your Meta platforms and your Alphabets and your Microsofts and Apple's running the economy, even though the stock market might feel that way and behave that way. So what do I like now? Well, as you could probably tell, I'm not super bullish about just buying the entire S&P 500 or Dow Jones or NASDAQ. But what about gold miners? Yeah, I do like them. I mean, they're down quite a bit, more than they really should be, as you can see on this chart here. So if you believe in buy low, that's the hard part for a lot of people. But if this is the 200-day moving average, the gold miners came down to the 200-day moving average, but came back up above it and held it. That's encouraging. Still below the 50-day moving average, but that's okay. If you believe in buy low and sell higher, then you don't always need candles to be above every single moving average all the time, do you? Or maybe you do. I mean, everybody has their own method. And oversold on the full stochastics here, for sure. So that's gold miners. And Bitcoin. I mean, there may be a pattern here forming, according to Nautilus Research on Twitter. We have Bitcoin. They're asking Nautilus Research, is there an approximately 3.5-year cycle going on, repeated over and over? Looks like it, right? Up, and then down, kind of a bull flag, as they call it, and then up, and a bull flag, and then up. Big correction, up, correction. Is it time to go up again? Maybe. Okay, and these things don't happen super quickly, okay? These are 3.5-year cycles, so you may have to be patient. If you're holding Bitcoin, that kind of thing, this may be a chart to look at. I'll give you a closer look at it. This is actually looking pretty interesting. So thanks to Nautilus Research for this, and thanks to all the providers of these charts. I want you to feel free to check them out if you want to. So extreme greed is not something I'm really into. It may be a time, and it's up to you, but if you want to consider taking profits on certain technology stocks, it's something to think about. And wait for fear and extreme fear to come back and find pockets of value wherever you can find them. Because it's been said that there's always a bargain somewhere. You just have to find it. So, hey, I want to thank you a lot for watching and listening, and I will talk to you again soon.